Hello and welcome to Earnings Echo. We put together the most important information about Datadog. Imagine a company having to grow its profits tenfold over the next decade just to, prove it's worth its current price.
It is a massive tightrope they are walking right now.
Exactly. So today we are skipping those surface level metrics. We're going to deconstruct Datadog's valuation using a reverse DCF model based on their latest fiscal 2025 data.
Right, to reveal exactly what expectations the market has already priced into the stock. But before we get to valuation, we really need to look at what they are actually earning.
Yeah, I want to critically question that earnings quality right out of the gate because looking at the fiscal 25 numbers, they reported a GAAP net income of just under $107.7 million.
Which is the strict accounting standard, yeah.
Right. Yet we are evaluating them based on their non-GAAP net income of $746.5 million. I mean, why are we relying on a number that is drastically like 7 times higher?
Well, because we are looking for actual cash-generating capacity here. Stock-based compensation, or SBC, it consumes roughly 20% of Datadog's revenue.
Okay, but under strict GAAP rules, that's treated as an expense.
It is, which severely depresses that headline profit. But paying employees in stock isn't a direct cash outflow from the company's bank account, so the non-GAAP figure strips that out. Once you adjust for a standard 21% tax rate, you get a much cleaner proxy for sustainable cash earning power.
Wait, I can't just let that slide. Are you saying we just ignore a massive expense like paying employees in stock? Doesn't that heavily dilute the actual shareholders?
Dilution is a very real factor, absolutely. But when you build a cash flow model to value the underlying business operations, treating SBC as a direct cash drain just distorts the operational reality. We were trying to measure the cash engine of the business itself.
And how is that engine actually looking right now?
It is undeniably robust.
Hmm.
Fiscal 25 revenue growth hit 28%, and if you look at Q1 of fiscal 26, that growth is already accelerating to 32%.
Okay, fair enough. The operational engine is humming. Let's figure out what we're actually paying for that engine. At the current share price of $184.67, Datadog commands a $65.9 billion market cap.
Right, which brings us to the reverse DCF.
Exactly. Now, a reverse DCF is not an exact science, but it is a vital tool to map the market's embedded assumptions. We were basically looking at a car already going 200 miles an hour and working backward to figure out the engine inside.
Let's look under that hood then. We apply a 9.5% cost of equity, a 3% terminal growth rate, and a 10-year horizon.
Okay, so working backward with those parameters, what kind of growth is the model demanding?
To justify that $184 price today, the math implies a fiscal 26 non-GAAP net income of $941 million.
Oh, wow. So the market already expects Datadog to significantly beat its own fiscal 26 guidance.
Exactly. Since management guided for only $878 to $908 million, the market is pricing in a massive beat.
And projecting that out 10 years is where the math gets exceptionally demanding. It implies a 26.1% net income CAGR over the next decade.
Right. A compound annual growth rate of 26% is extremely steep.
It means they have to scale net income 10x, reaching $7.55 billion by 2035. That is just to justify what you are paying for the stock today.
It is highly aggressive, but you have to weigh the probability. It is achievable when you consider their fiscal 25 net income just grew 36%.
But sustaining that for a decade.
That is the catch. A 10x growth requires both sustained 20% plus multi-year revenue growth and severe continuous margin expansion.
Which brings us to the most important echo for the investor today. The current $184 price bakes in the absolute bull case,
Leaving zero margin of safety.
Exactly. A pullback to the $140 to $150 range, which implies a more reasonable 20% CAGR, offers a far more attractive entry point.
Because the penalty for just an average quarter at these valuation levels would be brutal.
Right. And before we wrap up, think about this. If Datadog requires 10 years of flawless execution to justify its price, how will the rapid rise of AI-driven, self-healing infrastructure completely change their market before 2035 even arrives?
That is a huge structural risk you take on when you pay a premium for a decade of perfection.
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.